It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group.
Welcome back to the podcast. I asked at the end of last week's podcast what season it is. Professor Plum, we are indeed in season 8.
Okay.
I remember going back as a kid, the seasons meant, years. So if you had 8 seasons of a TV show like MASH, you knew that, it was 8 different years. I don't know how they figure a season of a podcast, but I think it's like 12 weeks.
And then we take a break.
And then we take a couple of weeks, and that's what we're doing here. But we're got a ton of things to talk about, and we had some questions from people about Roths. Now, the Roth, I should say who I am. I'm Johnny Dean, podcast host. People know me. Do they know me? I don't know, but I'm the podcast host. I'm not the advisor. But
I get calls, and people say, hey, so how's that Johnny guy doing?
Well, some people have known us for years, 20 plus years. Not just this, but on our Bucket Strategy Investing Show and all that stuff. This is Managing Your Financial Future. I hope I didn't say at the beginning of the podcast the wrong title.
I don't think did you even say a title?
I don't know that I did. I think I just said welcome to the podcast. But anyway, it's Managing Your Financial Future. And this is what we talk about. We talk about taxes. We talk about Social Security. We talk about strategies. Last week had a really good discussion, I believe, on the sequence of returns and what if you retire at the wrong time? And meaning what happens if you retire when the markets just go completely haywire?
I was going to say, the closer I get to retirement, I'm thinking, is there a bad time to retire?
Well,
it's seeming like a pretty good thing.
You would think so. But if you look, and I know that there's some people who get awfully scared about this, and we've done this thing we had this discussion also on guaranteed income and things like that. We've found somewhere, I think, that the more guaranteed income you have in retirement, the more secure you feel with the rest of your portfolio.
If you've got a check coming in every month that covers all your basic expenses, you're feeling a lot better about retirement than somebody who has to take it out of your savings account every month.
Yes, generally the more guaranteed type income. And when we talk about guarantees or guaranteed
Social Security, pensions, maybe a guaranteed annuity, something of that nature.
Yeah, it can be really helpful. So we do talk about things like this. And one of the facets of the bucket strategy, as we said last week, has to do with providing people with some type of cash flow that's either very stable or in some way guaranteed.
It's all part of the game of retirement.
Yes, while you can allow your other
more volatile assets time to get that potential better rate of return that you can get with guarantees.
Yes, and there's no guarantee on any of the stuff that's outside of the bucket one arena.
FDIC. I mean, those are all, when you're talking about things that have that G word associated with it, you're not talking about a lot of return. You're paying for that guarantee by not having a big return.
Yes, it's now you're getting the return of your money instead of the return on your money. You're sort of trading that off.
Now, there may be somebody out there that says, but I know somebody who's telling me I can get guaranteed principal and stock market returns with no risk. And it doesn't quite work that way.
It's funny you mention that. I got something in the mail. I've gotten 3 pieces of, actually my wife got it. It was in her name. 3 pieces of mail.
She's got all the money anyway.
Over the last 3 days in a row with these dinners, these seminars that tell you how you can do this. And
go to the dinners, keep your mouth quiet for a while, take notes, and find out what they're saying.
I've really thought about doing that. You get a dinner, but I think you're also wind up on the mailing list, and I'm just afraid of the repercussions. You're already on the mailing list. Well, my wife is. Now, she would go, but she would want me there, so I guess the two of us, I could go incognito. I don't know that it matters.
Yeah.
But I'd love to go and report back on that. I may have to do that.
Incognito thing. Years ago, when my son was about 12 years old, we were in the mall, and he saw, sign up to win this car. And so I said, they're just trying to put us on a mailing list. He wanted to win the car because, what 12-year-old wouldn't. And so we used a different first name than either one of our names. And that was when he's 12. He's now almost 35. And I got something in the mail. I've even moved in that period of time.
And I
got something to the name that we signed up for.
Was it the same last name, just a different first name?
Yes. Yeah. Same last name, different first name.
Isn't that great?
We're still getting mailings from that.
Well, it's funny. I was talking to my wife about things like retirement, as we do every so often, and we were talking about taxes and inheritance and all that kind of thing. And she mentioned something, and I said, well, that's not really going to be an issue if you happen to be in a zero. Oh, she said, well, when you take money out of a 401k or an IRA, I mean, obviously it's going to be taxed when you take it out. And I said, well, taxed, but it may not be. You may not actually have to pay any tax if you happen to be in a 0% tax bracket at that time.
Right. And there technically is no 0%.
Well, there isn't.
The tax brackets start at 10%, but that's based on taxable income after deductions. So you do get a certain amount of cash flow, taxable cash flow.
Yeah, a married couple is around 26,000 something for that.
Just shy of 26 if you're both under 65.
Yeah, and over 65, it's another.
You get another couple $1,000.
Yeah,
$3,000 for it. So.
Oh, is it $3?
Well, it's like $1,700 a piece.
Okay, well, whatever it is. Okay, so you get a decent amount that's
$1,400 a piece. So $2,800 more for two 65-year-olds.
Yeah, a decent amount that's that you can make tax free. And I had said that, and she says, well, how can you possibly have income that's not taxed? And I said, well, maybe you've got Roth income. Maybe you've got Roth IRA income.
Roth cash flow coming out of your Roth.
Cash flow coming from your Roth. You're right.
And then you've got your Social Security, and Social Security may or may not be taxable, depending upon what other income you have, not including Roth income or Roth cash flow. So I could have, $20,000 from my Roth and $30,000 from my Social Security, and another $10,000 from my traditional IRA. And I'm not paying tax at all.
Well, that's just it. And my wife, who she's not as well versed in this stuff, because we talk about this all the time, so I'll know a little bit more. And she said, well, wait a minute. So wait, if you take money out of a Roth, that doesn't count as income. I said, well, it doesn't count as taxable income.
Does not show up on the tax return.
No. And
obviously assuming it's a qualified distribution. Okay.
Absolutely. No, we're making that assumption. And she said, well, gosh, it sounds like the Roth is something that everybody should have. And I said, well, a Roth, it would be nice if everybody had a Roth, but what do you have to do to get the money into that Roth?
Well, you have to earn money. Mm-hmm. And if you are earning more than, $25,000, $30,000, you're paying tax on those earnings. And then you're putting it into the Roth IRA, and you're not getting a deduction up front. So it's an after-tax contribution. So there's a cost of doing business with IRAs.
Well, and so she had said, well, so there's an income limit. I said, yeah, if you make over a certain amount, I think it's 200, a married couple.
204 for 2022.
204,000. That's the lower limit.
Phase out, yes.
Yeah, and then it phases out to 214, I guess. Still a $10,000 phase out. So I said, so if you make more than that, then.
Well, it's a $10,000 phase out for a married couple. It's a $15,000 phase out for a single individual.
Go try to figure that out.
Lower, 129 to 144.
Sure, it should be half, and it should be anyway, whatever it is. So her question was, well, I mean, people who may need the Roth the most are the ones who aren't necessarily going to get it. And I said, well, there are other ways to do it too. You can also convert money,
right, from a traditional IRA to a Roth IRA, from a traditional 401k, a traditional retirement account, basically, to a Roth account.
That's another way to get money into a Roth.
But again, there's a potential cost of doing business. The movement of money from a traditional retirement account, 401k, IRA, whatever, to a Roth IRA is a taxable event. How much in taxes do you have to pay? Well, that depends on what other income you have.
Exactly. So what if you wanted to convert, say, money in your IRA, or I guess your 401k, you would have to run it. It would have to be taken out and placed on top of all of your other income that you had for that year, right?
So if you have no other income, that's a great time to be thinking about Roth conversions, assuming you've got enough money to live somewhere.
Because a portion of that money
would be tax-free.
Would be tax-free.
I mean, if let's say I've got $50,000 in the bank that's earning, we know how much that's not earning right now. So it's earning nothing. It's not going to earn any interest. And that's what I'm going to live on this year. I could do conversions, and if I'm a married couple, the first $25,000, $26,000 is not taxed at all. Zero, not a zilch, zippo, because that's the only income, and the standard deduction wipes it out. And why not do that? If I find myself in a low income tax, and maybe then the next almost $20,000 is at a 10% bracket. So I could do $35,000 at a cost of like $1,000 or $2,000 taxes or so.
Whatever it is, it's not bad. And the good thing on the other side of that is that if you build up a Roth big enough that you could potentially live off of that money, again, that's money that's going to come out tax-free, assuming it's all qualified.
And it does not affect the Social Security taxability. Normally, cash flow from an IRA, if I'm taking $20,000, $30,000, $40,000 out of an IRA, then that's going to subject a good portion of my Social Security to taxation as well. If I'm taking $20,000, $30,000, $40,000 out of a Roth IRA, it has absolutely no impact on the taxability of my Social Security benefit.
So there are income limits when speaking about a Roth IRA.
Well, contributing to a Roth IRA.
Yes, contributing to a Roth IRA. And I mentioned, we talked about things like conversions. Who can do, what we were just talking about conversions, who can do a Roth conversion and who should do a Roth conversion?
Well, there's two ways to get money into a Roth IRA. One is to contribute from your earnings, from your, you have to have earnings to support a contribution. That's limited to $6,000 or $7,000, depending how old you are. But you can also do a conversion of existing traditional retirement assets, IRA, 401k type money, and there's no income requirement. This is what confuses a lot of retirees. In fact, we'll talk about, you're in a pretty low tax bracket this year. You've got maybe a little Social Security, but not much else going on from an income standpoint. Let's start doing some conversions. And they say, well, I can't convert because I don't have a job anymore. Well, that's a contribution. It requires a job. A conversion, anybody that has traditional IRA money, traditional 401k money can do a conversion. There's no income limits either. And you mentioned Roth IRAs came about in 1998. When Roth IRAs first came out, there were limits on who could contribute.
Yep.
And there were limits on who could convert from traditional to Roth.
Income limits.
Income limits, yes. If your income before the conversion was more than $100,000, you could not do a conversion.
And that was married or single, as I recall.
And so that really kind of hampered, the conversion style for a lot of people. But in 2010, they said, we're not getting enough people to convert to Roth, so we need to open it up. So they took away the income limit for conversions. They didn't take it away for contributions. They only took it away for conversions. So now anybody, regardless of age, regardless of income level, regardless of job status, can do a conversion. Now, this next question is, should you?
Yes. Somebody with who's staring down, let's say they're age 62, 63, 64, and they know at age 72, they're going to have this pretty large IRA and maybe 401k and a bunch of others where they're going to have a large required minimum distribution. They're concerned about the tax implications of that.
Right.
Who should consider doing a Roth conversion?
Roth conversions should be considered for people who are in a lower bracket today when they're doing the conversion than they expect to be when they would normally take the money out of the IRA. So if you're sitting in a position right today where you may be you're not taking your Social Security yet, and you're in the 12% bracket, 10, 12% bracket, and you can do some amount of money in the 10, 12% bracket, but you're saying, well, I could go without paying any taxes right now too. Mm-hmm. But then you look forward to when you're 72 and you say, at that point, I will have my Social Security and I will have a required minimum distribution. And not only will the required minimum distribution be taxable, but I'll be subjecting a chunk of my Social Security to taxation as well. That puts me in a higher bracket in retirement than I am right now. So if I'm in a higher bracket in retirement when the money would normally come out than I am today, you're a good candidate for a conversion. Probably not the entire thing, but some amount of money. Now, on the other hand, I was speaking to somebody who makes a decent amount of money. They make a little over $200,000 a year, and they did not have a huge, they hadn't built up millions of dollars in their 401k yet. They had a couple $100,000, and they were in their 50s, and they were saying, should I start doing the Roth 401k, or should I start converting to the Roth 401k? So, well, what's your tax bracket now? Mm-hmm. Well, your tax bracket was, at that time, it was 25, but today it would be 22%, plus the state that they lived in. And I go, and when you retire, where are you going to live? He goes, not in that state. He was going to move to a state with a much lower income tax, and his total income was going to be cut in about half. And so I said, so you're going to be in a much lower income tax bracket when you retire? Yep. Then why would you want to pay the taxes today at a higher rate to be able to get a tax-free rate later on? So if you're in a higher bracket today than you are going to be in a retirement, not a good time to convert. If you're in a equal or lower today than you're going to be in retirement, or even for retirees, if for some reason you're in a low income tax bracket today and going to be in a higher one later on, you may want to do the conversions at that point.
So it's just a question of how much you're going to pay today versus how much you could potentially pay later on.
And now some people will look at it as also, I probably will be in the same now and the same later, but with the new required minimum distribution rules and everything, and I know my kids, they're just going to take it out in one lump sum, they'll be in a higher bracket because I'll probably pass while they're in their highest working years in their 50s. And so to help them, I'll pay the tax today because they'll pay a lot more later on. So we'll try to work it out that way. So it's, when is the money expected to come out? What's the tax bracket this money is expected to come out in? Higher today, lower today, higher tomorrow, lower tomorrow. How do we want to work this? Now, I've also done this with a lot of people where they said, that makes a great amount of sense. So let's do this amount of money. And then it's going to cost you that much in taxes. Oh, I have to write that check? Yeah, you have to write that check. Now, in the past, it was, they do it, they're all up, they're all perfect with it when you do the conversion. Then when they do the taxes, they come back and say, oh, that thing cost me that much money. Well, we talked about it. He goes, yeah, but now I have to write the check and I feel it.
Yeah.
In the old days, we could undo a conversion. We had a mulligan.
That's right.
No mas.
No, once it's done, it's done.
A conversion is a done deal. You cannot undo a Roth conversion.
You had a certain amount of time to do it.
Yeah, you do it before you file the return plus extensions.
Yeah.
But not anymore.
No, it's done. It's a done deal.
It's an irrevocable decision now.
Well, but in many ways, unless this money is going to be money that's inherited by, well, even if it is, I mean, somebody's going to pay taxes on that IRA money. Most likely they're going to have to pay taxes now or pay taxes later on that IRA money.
So
or 401k
how do we
money.
make it as efficient as possible? Pay the least amount of tax as possible. Sometimes that means conversions early. Maybe it means conversions all along. But it has a lot to do with planning. Oh, how dare we talk about planning? Because you have to understand, where's your income going to be coming from?
Yeah.
And sometimes you've got some pension, you've got your Social Security, and you've got a decent amount of assets. And one of the mistakes a lot of people do is they'll live on there and they'll go online, and I see it almost every day. The worst way to withdraw money in retirement. And they always talk about never spend your IRA until 72 and you're required to. Definitely don't spend your Roth money.
In other words, put off the taxes for as long as possible.
Spend your personal money first. And that could be a disaster for some people. Like I was talking about earlier, I may have a couple $100,000 in the bank account, and I could live off $50,000 a year for 4 years and have absolutely no income taxes. Because all I'm doing is withdrawing $50,000 from my bank account that's earning absolutely nothing in these days. And so I don't have any taxable income. Then I start my Social Security. Then I start taking money out of the IRA. And now I'm getting hit twice. Tax on the IRA and tax on the Social Security. I should have been taking at least the standard deduction equal to out of the IRA every year. Because in that example, I could be taking some amount of money out and not paying any taxes on it. Take
advantage of the low tax bracket is what you're saying. If you're in a low tax bracket, if you know that you're in a, if you can take money out tax free, do it.
Yeah, I mean, and low may be, for some people I've met, low was the 24% bracket.
Yeah.
Where in the future they were going to be in the 35.
Well, somebody like that is probably making a good amount of money if they're still working. They may have asked the question, and we've had this question too before. How can I know there's an income limit for a contributions to a Roth.
Well, I want to save money. I'm maxing out my 401k.
Yes.
And I can do a traditional IRA. Now, traditional IRAs, I can, unlike a Roth IRA, a traditional IRA, I can contribute to a traditional IRA regardless of my income level.
Yeah.
Now, somebody out there is going, oh, he's wrong. I finally found something he's wrong at. No, I'm sorry, not. You can contribute if you've got a job. You just may not be able to deduct the contribution. The contribution is allowed. The deduction is what is phased out for people that make more than certain amounts of money. And so,
it was 100 something, close to 100.
It's 109 to 129 for a married couple.
Yeah.
And it's 68 to 78. Now, there's a phase out that works. I mean, 20,000 for a married couple, 10,000 for.
What do you know?
But if I make over that level of adjusted gross income, I cannot deduct the contribution, but I can still make the contribution.
So if you're looking for a way to get money into a Roth, because you want to save more, but you've already maxed out your 401ks and all that other stuff.
And if I can't get a deduction on the traditional IRA,
what's the point?
And if I do a non-deductible traditional IRA, I'm basically married to a Form 8606 for the rest of my life.
Yeah.
There may be some help. So what you can do, now this, if you have no other traditional IRAs, no SEPs, no Simples, no traditional IRAs in your name, maybe your spouse does, they can't do it, but you can in this case. You can do a non-deductible traditional IRA contribution.
Which we just said, it doesn't matter what your income is, you can do this.
You just
as long as you have earned income.
Yeah, and if you're making $300,000 a year, you cannot deduct that traditional IRA contribution. Now, one caveat to that. The deduction phase out for traditional IRAs is dependent on you having a retirement plan at work. So if you have a 401k, if you have a pension plan, if you have any kind of retirement plan at work, that's where the phase out. If I don't have any retirement plan at work, there is no problem with deducting a traditional IRA. People that are making $200,000-$300,000 have a retirement plan at work, or they have their own business and they're doing a retirement plan at their own business.
They have to be an active participant in that plan, though. Not just have it available to them. They have to be a participant.
They have to be participant, but that also means, does the company put money in for you?
Right, of course.
Not just you contributing.
Yes.
So a lot of people have 401ks. A lot of people are over the income limits. They're over the income limit to be able to contribute to a Roth IRA directly, and they want to save money. Mm-hmm. Now, they're not going to get the tax deduction. So if I'm not going to get the tax deduction, why would I want to do a traditional IRA? I really want to do the Roth because that gives me benefits in the future. Yeah. The earnings will be tax-free. Whereas if I put the money into a traditional IRA, in the future, the earnings will still be taxable. So we still have a provision. They tried to get rid of it, or they talked about getting rid of it a year ago, but none of that passed.
Yeah.
So it's a still viable option. I can make a non-deductible traditional IRA contribution and then convert it. I'm limited to my contribution as far as my deductibility. I'm too high. I can't go directly to a Roth contribution because my income's too high.
Too much.
But there is no income limit on the conversion. So I put my $6,000 or $7,000, depending on age, into my traditional IRA, and as soon as it's cleared up and ready to go, I flip it to a Roth IRA.
You do a Roth conversion because now you have non-deductible money sitting in a traditional IRA, and you can now convert that non-deductible money because that's all you've got in your IRAs.
And I have to pay tax on all the pre-tax money that I convert across. But the only thing in any of my IRAs is this $6,000, and all of it's non-deductible. So it goes over to the Roth IRA without a tax because I've already paid the tax.
So you've, in essence...
I've done a backdoor Roth contribution. It is not a Roth contribution. It's a conversion.
Yeah.
It's a traditional IRA contribution or conversion. Now, I did say, if you have other IRAs, it really muddies the water.
So other IRAs like what? Deductible IRAs, pre-tax IRAs?
A simple IRA, a SEP IRA, a rollover IRA, a former 401k that's now sitting in an IRA, former IRAs that I've contributed to regular or non-deductible that have earnings in them, any type of pre-tax money. And it doesn't even have to be this account. I may have an account at XYZ brokerage company that's got $100,000 in it, and I open a new traditional IRA at ABC and put it all into the new ABC. And this account has no pre-tax money, has no deferred money. It's all after tax, and I convert just this account. I can track that perfectly. I have great accounting skills in this. IRS doesn't care. You have pre-tax money. You had $94,000 in your other IRA that was all pre-tax, and you had $6,000 in this IRA that was after tax. You converted this $6,000, and 94% of that's going to be taxable because my total IRA was $100,000, and $6,000 was after tax. The percentage of after tax in the total picture here was 6%. Therefore, this is just IRA rules. So having other IRAs is a problem. Now, how do we get around that? Do you have a 401k? Do you have a 401k that accepts IRA transfer ins? You could take all the pre-tax money in your IRAs and transfer it to your 401k. It's only the IRAs that screw up this taxation. Mm-hmm. If I put it into the 401k, now my IRA doesn't have any money in it except for the after-tax money. Now I can do the backdoor Roth.
So you can take these, if your 401k administrator allows it,
yes,
you can take these pre-tax monies that are in your IRAs and potentially roll them into your 401k, assuming it's allowed. Now, somebody might say, well, wait a minute, I thought I couldn't put any more in my 401k because I've already contributed up to the maximum.
$20,500 this year. This is not a contribution. This is a transfer. And like we said, if your 401k allows it. Now, some people don't like doing this, though, because they really like the investments that they have in their IRA, and they don't have those options available to them in the 401k.
Limited, yeah.
So you've got to weigh the two issues against each other.
Yeah. But that's a way to do it, potentially.
It's for a lot of people, it's a pretty good way. And it allows you to, in essence, get a Roth contribution when you weren't technically eligible for one. And is it legal? Oh, it's 100% legal. I mean, there is nothing wrong with it. And it came from the idea that they passed tax law 24 years ago and then amended a portion of that tax law 12 years ago.
Yeah. And
opened up something that, whether they thought about it or didn't think about it, gave us the ability to do this. And they've affirmed it and said, yeah, we're fine with it. Now,
it's an odd thing.
Now, they will probably talk about taking it away again because by definition, only the rich take advantage of this, because by definition, only people that make more than $200,000.
Well, sure, of course,
are having this issue.
Well, that's true.
Yeah,
that's true. I mean, we won't get into the machinations of that particular, and it could go away at some point.
Right, but for now, it's totally legit, totally legal. If you want to be able to contribute to a Roth IRA, but are above the limit.
Now, if you have a bunch of other IRAs, pre-tax money, earnings in whatever.
Yeah, it becomes problematic.
It becomes problematic, I guess, because if you try to do the conversion, you can't convert the whole non-deductible.
I can convert it, but it's going to be a taxable conversion. I no longer am making an after-tax contribution and getting it to a Roth IRA tax-free. I'm making an after-tax contribution, and I'm also paying tax on the money that goes to the Roth IRA in this instance, or the majority of it.
But if you roll the money from, say, your 2 or 3 or whatever IRAs into a 401k, there's no tax paid on that.
No, transfers between retirement accounts done correctly is tax-free. Now, I will say this. If you're going to do this, especially I saw somebody do this in the last year of their working life. They didn't realize it was going to be the last year of their working life. They did the transfer into the 401k in January. They did the Roth contribution and conversion in March. And they were thinking they were going to continue doing this. But then they got laid off in August. And they rolled their 401k to an IRA in October. Now, when they did the backdoor Roth conversion, they had no IRAs. And so there was no taxability.
Yes.
But they don't look at it on that day. They look at it as
the end of the
year, basically. And they say, what's your IRA balance right now at the end of the year? And
so what happened? They
had to pay tax.
Which I guess
they were going to do it at some point, but yeah, they had to pay tax on the conversion.
Well, that's just something else that you got to look out for. And these are some of the Roth tricks. I mean, can you ever really go wrong having money in a Roth IRA? I mean, once it's in there,
can you ever really go wrong with having money saved?
No.
So now it's just a matter of what's the most efficient way to not go wrong. Hey, if I retired and I had $1 million in my IRA, or I had $1 million in my Roth IRA, I'm still feeling pretty good either way. Now, at retirement, I'd rather have the Roth, but getting it there may be a problem when I'm working.
Well, that's just it. I mean, I'm saying if there's money in the Roth, there's no real reason to take it out of a Roth and put it into something else. I don't think you can
if you've
anyway.
Got money in a Roth,
because
your only option is to take it out and put it into the taxable world, which would then have taxes on earnings every year that you earn anything.
Right. So getting money from the traditional into the Roth is often a good idea.
And once it's in the Roth, you're not going to, other than taking it out and spending it, you're not taking it out to change the character of the account.
Very quickly, what about RMDs where Roth IRAs are concerned for the owner?
For the owner, good thing you threw that in. There are no required minimum distributions for the owner of a Roth IRA.
What about for a spouse that was left widow?
The widow?
Yes.
If the widow rolls it into her own name, his or her own name, now they are the owner of the Roth IRA. There's no required minimum distribution. Beneficiary, though, if I'm the beneficiary of somebody, and
what if this goes from parent to child?
that child is the beneficiary of the account. They have a required minimum distribution. Required minimum distributions for beneficiaries are exactly the same between Roth IRA and traditional IRA.
And are there taxes to be paid? Because I've had this question too on a required minimum distribution for a Roth.
Most likely no, as long as it's been 5 years from the original date of the beginning of the Roth IRA for that owner. Now, if you have somebody who opens a Roth IRA last year, maybe they opened it in 2020, let's say that, and they picked a stock, they did a conversion of $100,000, and they picked some investment that just went up to $400,000. And then this year they die, and the heirs take it and take the money out of it.
Yeah.
They're going to pay tax on that earnings because it has not been 5 years that owner had Roth IRAs. They started their very first Roth IRA in 2020. The people took it out in 2022, 2023. Whatever earnings are theirs within the 5-year window, they're coming out taxable. No penalty, but taxable. So assuming it's been at least 5 years since, and with the new rules of the 10-year required minimum distribution, you can always wait out the 5-year period.
Yeah, we can get into probably that. There are a series of 5-year rules with both Roth contributions.
There's 5-year rule for contributions and 5-year rule for conversions. They're different 5-year rules.
Yes.
And
which we didn't really address in this. We just talked about getting money into the Roth.
But most of the time when you inherit a Roth IRA, it's going to have been more than 5 years since the owner opened it, and therefore any distribution that you take will be tax-free. It'll be a qualified distribution.
But check with your advisor to be sure.
Just make sure that they didn't, hit that one stock that quintupled in 6 months.
Which was the perfect reason to do a Roth IRA.
And put that investment in it too.
And hope that maybe you can do that and hope that it stays high for the next 4.5 years.
Or if that's the case, if you're worried about it dropping, sell it, leave it in cash for the balance of the 5 years.
That's true. You could do that because you're leaving it in the Roth.
Right.
Right?
Right. But yeah, most of the time beneficiaries of Roth IRAs
they
will have a required minimum distribution, but most of the time it'll be tax-free.
Well, if that happened to me, you know what? Tax or no tax, I'll be happy to that's fine. I don't care.
I'll wait out.
If I want the money now,
I'll wait out the remaining 1 or 2 or 3 years.
Yeah, that's fine. That's fine. If you need more help with this stuff, we talk about Roth IRAs all the time. We talk about the strategies using Roths. Should you do a Roth? Should you do a traditional? There are reasons to do both. I mean, not everybody should consider doing a Roth, even if they can, right, Professor Plum? It's contribution.
It's all about your particular situation.
Yeah, I mean, there are some people just purely for tax reasons should probably consider doing something that they can get a deduction for today.
Right, assuming you can get that deduction. If you can't get the deduction, wow, the Roth is a pretty good idea if you can figure out how to get use of it.
It can be. And once you hit retirement, as Professor Plum said, I mean, you really can't go wrong with having money in that Roth IRA account. So if you want more help with this stuff, give them a call, 800-644-1150, the number at Lucia Capital Group, 800-644-1150. You can also go online at luciacap.com. That's the website for the folks at Lucia Capital Group. Find the videos. You can find some of our old, I think some of even our old Bucket Strategy Investing shows or segments might be on there. I'm not sure. But we've also got webinars coming up. We're going to be talking about things like Social Security taxation this year. We've got one coming up not too long from now, talking about retirement and buckets and all that stuff. So keep an eye out for those topics because Professor Plum, you go in and you get into some of the details, visual details of some of these topics that we talk about.
A little bit. Now, if you're listening to this, you just missed one a couple of weeks ago too, though. So they'll come around again.
Well, that's true. They will come around, and we do occasionally we make them available on demand. We can't always do that. They have to go through compliance and all that. But once they do, we may be able to make it available on demand. But check it out at luciacap.com. You can also find us on Spotify, this particular podcast, Managing Your Financial Future. Go to Spotify, subscribe to it, get the episodes downloaded to your device. Listen regularly because we cover a lot of these topics, and you won't want to miss this. I'm telling you, it's all important financial planning stuff. Spotify. My thanks to Professor Plum.
You're welcome.
You're going to get through this coughing that if you've heard his coughing in the background, it's not COVID.
I have tested.
Yes, it's fine. It's just your once a year, generally this time of year.
I went about 3 or 4 years without it. Now it's coming up a little more than once a year. It's like bumming me out.
Does it have to do with age? I don't know.
No, just it has to do with poor care of my body for the last 100 years.
Well, and that goes hand in hand with age. You had poor care of your body when you were like 28, but, it didn't seem to matter quite as much. Now here we are 40 some odd years later.
Reap what you sow.
Absolutely. Anyway, Professor Plum, certified financial planner professional. For him and for the rest of the gang at Lucia Capital Group, I'm Johnny Dean, your podcast host. Thanks so much for listening, and we'll talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as a receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties and, if taken prior to age 59.5, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Distributions of principal from a Roth 401k are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth 401k was established, whichever is longer. Your investment options are limited with a Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.